Majority Sale Auction Process Part 1. This is Lesson 2 of Class 1. In this lesson, we will review the steps and the procedures required to close M&A deals. Background. The latter half of the deal funnel and majority sale processes can be broadly defined by a few important steps. Bid instruction letter, indication of interest, letter of intent, definitive agreement. In this lesson, we will discuss the procedures associated with each step, the more important attributes of each step, the best practices that practitioners should keep in mind when advising on the back half of the deal funnel. Bid instruction letters. Prior to launching an M&A process, practitioners will outline what is called a bid instruction letter. A bid instruction letter is a document that provides guidance to prospective buyers on how to submit a bid. The bid instruction letter will likely include a few main parts: submission deadline date, contact information of the investment bankers, bid package requirement, due diligence requirements, target date, close. Some of the most important aspects of the bid instruction letter are contained in the bid package requirements section. In this section, practitioners outline timing and number of expected bid rounds, and also identify key items needed from the potential buyers, such as valuation range, purchase considerations, and whether or not the buyer will utilize leverage. Bid instruction letters continued. Delivering the bid instruction letter to potential buyers. Going back to the kickoff call, the bankers and the client will discuss timeline expectations and agree upon a deadline for first round bids. The bankers will typically send around bid instruction letter to the interested buyers after the management presentation. By this time, the interested buyers will have had time to execute an NDA, discuss the deal with the bankers during the intro call, meet with the target's management team during the management presentation, conduct preliminary due diligence in the VDR. There are no specific guidelines on delivering the bid instruction letter, but the earliest time at which one should extend a bid instruction letter is following the completion of the NDA. Without reviewing the VDR materials and the SIM, there would be no way for the bidder to extend a sensible bid. Also, another key guideline to keep in mind is that the goal of the bid instruction letter is to ensure fairness within the auction process. The bid instruction letter should be uniform for each deal, and it should aim to create a fair process for each potential buyer. Indications of interest. Bid instruction letter provides guidance on how around the auction process and the details and stipulations around how and when potential buyers must submit their bids. The first round bid is known as an indication of interest, or an IOI. The basics of an indication of interest. When the buyer submits an IOI, the buyer provides a formal written document to the sell-side investment bankers outlining their preliminary interest in the target. The IOI is not legally binding, but represents a starting point for the parties to begin or not to begin negotiations, depending on the attractiveness of the bid. The IOI's structure should, at a minimum, be aligned with the requirements noted in the bid instruction letter. The main features of an IOI. Purchase considerations. The type of payment to be utilized in the deal, either stock, cash, or a combination of both. If stock is being utilized, the buyer will likely put forth a preliminary conversion ratio. Valuation range. The purchase price that the buyer is willing to pay for the in a form of enterprise value, or EV, which is the equity price of the target plus the target's debt minus its cash, or net debt. In the IOI, the buyer will likely express a purchase price and a valuation range rather than an exact number. The buyer can also provide additional guidance on how they arrived at the valuation. Also, there might be an earnout component of the purchase price, which is future considerations paid to the seller depending on the performance of the target business following the transaction. Check size. In the IOI, the buyer will typically provide guidance on whether or not it plans to utilize leverage. If the buyer plans to utilize leverage, the check size, or the buyer's equity, will be less than the purchase price. This means the buyer will be financing the remaining portion with debt or asking the seller to roll over equity. Main features of an IOI continued. Special request personnel conditions. If the buyer assigns value to the target's management team, the buyer could add stipulations into the IOI that outline future employment conditions for key management members. Basically, if the buyer doesn't think it can manage the underlying business with the same degree of success as the current management team, the buyer will encourage the target's management team to continue working. For example, the buyer could ask for the management team to sign employee contracts that extend employment and or non-compete agreements. If the purchase price is inclusive of rollover equity or additional earnout considerations, the target's management team will be aligned with the company's future success and ill-incentivized to leave the business or compete against the business. Main features continued. Further due diligence. The target is going to want to know what additional due diligence outside of the norm will be required to close the deal and the timelines associated with those diligence requests. Any additional diligence requests from the buyer needs to be contemplated because diligence tasks take time. There is a famous line in investment banking that says, "Time kills all deals." All things equal, the seller is going to want to select the buyer with the shortest path to close, and therefore additional diligence requirements or longer diligence timelines are detriments to the seller. Additional notes. It should also be noted that the IOI is typically for discussion purposes only, and that bids are sometimes formatted without signature blocks. This means that an IOI from a seller's perspective is to help the seller better understand the market. There's no obligation for the seller to sell to the highest bidder. The collection of bids shows the seller allows the seller to weigh out its options and narrow down the participants that will continue in the process. If the seller is unintrigued by the terms of a particular bid, the bankers will kindly communicate to the bidder that the seller is no longer interested in moving forward. This saves the potential buyer from expending both time and resources in further diligence. The bankers will remove the potential buyer from the VDR to reduce exposure of confidential information. Thank you for tuning in to this video. We look forward to seeing you in our next video, which will cover part 2 of majority sale auction processes.